All right, guys. So CPI came in today at about 3%, which is a little bit higher than people had wanted. And then right after that, our good friend President Trump came out and said, based on the CPI report, we need to cut rates. That makes no sense. If you want to keep prices down, you raise rates. If you want prices to speed up, you cut rates. That's the whole idea there. That's what makes me get a little annoyed with the politics of everything, saying, listen, guys, you can't sit there and have your cake and eat it too. You can't have low rates and decreasing inflation. Low rates are done by the central banks so that banks can borrow at lower rates and give their borrowers even better rates. When the cost of borrowing is lower, people tend to invest more, they tend to spend more, and therefore it spurs the economy on. It's just very basic Econ 101. Actually, probably Econ 102, it's macro, but you get the idea there. Now, this is all political fodder, and people are going to sit there and say, oh no, he's right, or oh no, he absolutely is wrong. And I voted for Trump, but he's absolutely wrong on this part. You do not want lower rates if you're trying to keep costs down. The Fed's goal was 2% inflation on the core, and core removes energy and food prices because of how volatile they are. So, with core inflation still increasing, with a 0.5% increase in overall CPI, that's a lot, guys. 0.5% every month would be over 6% a year. That's a lot of inflation, and that's what we want to avoid here. So again, cutting rates is not a good thing. Now, how did the markets react? You literally go look at pre-market, and the NASDAQ, S&P, and Dow just a absolute cliff down the market. Absolutely plummeted. A lot of tech stocks taking a retreat there. You saw Bitcoin falling, Coinbase falling yesterday. So we're off to a rocky start. I believe the market's still up this year, but let me verify that. Yeah, the markets are still up this year for the year, which is surprising because of all the volatility we've had. But I imagine there's going to be a lot more volatility as time goes on, as this progresses. So yeah, the markets are still very volatile this year. I'm actually surprised to see that we're up because if I hadn't paid attention and looked at that, I would have thought we were down because of all the down days we've had. It's just very volatile. Valuations are still sky high. In our previous 24/7 video we did on Monday, we showed you guys where valuations were 115 and 120% overvalued based on the two most reliable metrics in history on valuations at any given time. So what does this mean? It just means it's time to be cautious, stay with your plan, continue on with your plan, but be ready for terrible returns for the next 5 or 10 years. That doesn't mean you can't do very well. As I repeat over and over, in March of 2000 was the peak of the NASDAQ. It started to fall 83%. It continued to fall 83% from peak to bottom. And if you dollar cost average starting at the peak, going until now, you'd have made over 15% annualized return on your money. So still a lot of opportunity out there, but CPI is a central focus for investors right now because they're worried about all these costs keeping people at bay. We still have a very low unemployment rate. It's also inflationary. When we have a lot of people who have jobs out there, what happens to costs? Well, people get jobs easier, rates go up, wages go up, business owners have to pay more money to get good workers, and it leads to increased costs for goods and services to everybody out there. It's all inflationary. You cannot have your cake and eat it too. There is no world that exists where you can have low inflation with low rates for long, long periods of time. Even look at it when we had, now you might sit there and say, well, Paul, what about since the great financial crisis? Yeah, that was one I was totally wrong on. With the great financial crisis, the difference is the money wasn't put into the people's hands. It was put into the bank's hands to bolster their balance sheets. After COVID, we put the money into people's hands. We were giving them so much money that they didn't have to work. They could be pickier on jobs. So business owners like me had to go pay way more money to get the same work done. That's inflation. This is not a coincidence, guys. If the cost of labor goes up, the cost of goods go up. That is just natural. It makes perfect sense. So don't fall for that trap that Trump is trying to say out there. Like, we can have low rates and can't happen. It just cannot happen over long periods of time. And on top of that, Fed Chairman Powell has been very clear that he's not going to react and that the decision on interest rates is very fluid. It's going to go up and down, up and down. They're going to react to the information that they get, and they're not going to be very quick about this. And the 10-year Treasury, if you see, skyrocketed right after the report. Why? Because when inflation's higher, the expectation is that the Fed will raise rates. If the Fed raises rates, what happens to all the treasuries down the road? They also go up along with it. So with the expectation of higher inflation and higher rates, the 10-year Treasury did a marked move from like 4.53 to over 4.6%. That's a big move, guys. That's nothing to laugh at. That's nothing to scoff at. That is a big move. And guys, if you look at our heat map on the S&P right now, a lot of green. A few up. Intel's been surging because of yesterday. JD Vance made some comments about Intel, very positive comments. Palantir is up 2.25%, Tesla's up over 2%, Dell's up, Eli Lilly. But even for the broad markets, everything is down a lot. Nvidia down 1.5%, Microsoft 1%, Oracle down 3%. Remember, guys, we've said over and over again, what drives the market up is going to bring the market down. You see a lot of healthcare in the green, healthcare plans in the green. But this is, before in the past, if you guys looked at our videos when we had big down days in the market, it'd be the big drivers of the market, the Magnificent Seven being down, and the rest of the market being more green. Now we have a very spread out and diverse red market. I don't know what that means for the future because remember, nobody knows what's going to happen in the short run. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. So don't try to guess what's going to happen. Stick to your plan of dollar cost averaging into low cost index funds. And if you're able to buy good companies at great prices, continue to do so as markets fall. Thank you for your time.